And a further sign that all is not well with the mid to low-end U.S. consumer, according to Fitch Ratings, the share of subprime borrowers at least 60 days delinquent on their auto loans rose to 6.65% in October. That's the highest level going back to 1994. Now, Disney reported Thursday morning with mixed results. No matter how you look at these numbers, they are just not great. There's no total growth here. Last week, Michael Burry announced that he had taken an option short position in several AI names. Now, let me explain what he is getting at. The big question as to AI spending is what kind of returns and cost savings these massive investments will or won't bring. That is the key question. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending November 14th, 2025. Before we start, I want to address several comments I've gotten about my appearance and my thinning hair. Now, for those of you who have been listeners for a while, this is old news. But for newer viewers, I just want you to be aware that in June, I was diagnosed with breast cancer. Now, my doctors are confident of a complete cure. But right now, I'm in the middle of chemotherapy, hence the thinning hair. And I expect within the next several weeks, I will probably lose more or all of the rest of my hair. So I'm starting to wear a hat. Moving on. The big news of the week was that the government shutdown finally ended. On Monday, 8 Democratic senators crossed over and voted to reopen the government. The House passed the bill too, and the president signed it Thursday morning. Now, this legislation only provides funding through January 20, so maybe we will be going through this all over again, but hopefully not. On this news from the Senate on Monday, the market staged an impressive rally. But since then, nervousness about AI and the economy have crept in, and the market had a decline on Thursday, with NASDAQ down over 2% and the S&P 500 index down almost as much. 2 weeks ago, over 150 companies reported. Last week, over 130 reported. Now this week, only 10 companies in the S&P 500 reported. But lest you think that means that earnings season is over, then think again. Because earnings season does not end until NVIDIA reports. And that's next Thursday. But before we get to earnings, I want to flag 3 things. First, and a further sign that all is not well with the mid to low-end U.S. consumer, according to Fitch Ratings, the share of subprime borrowers at least 60 days delinquent on their auto loans rose to 6.65% in October. That's the highest level going back to 1994. Also, as I mentioned in last week's wrap, last week, Michael Burry, who was also portrayed in the Big Short movie, announced that he had taken an option short position in several AI names. This week, he posted on X at least part of his thesis. He posted a table showing that Meta, Google, Oracle, Microsoft, and Amazon have increased their network compute depreciation useful life from 3 to 5 years in 2020 to 5 to 6 years in 2025. Now, let me explain what he is getting at. Suppose Meta buys 75 billion of network computing equipment in 2025, which is actually what Meta is actually spending. However, it does not report 75 billion in expenses in 2025. It reports those expenses over time according to a depreciation schedule. Now, in 2020, Meta would have depreciated that amount over 3 years, or 25 billion per year. But now it is doing so over 6 years, or expensing only 12.5 billion each year for 6 years. So in this simplistic example, Meta's pre-tax earnings are 12.5 billion higher than they otherwise would be. Burry is arguing that the hyperscalers are artificially inflating their earnings simply by changing their depreciation schedules. And with respect to Meta, Burry claims that this change in the depreciation will overstate Meta's earnings by 21% by 2028, and for Oracle by 27% by 2028. Now, I've gotten questions from viewers as to what I make of all this. And here's my thoughts. Let's accept Burry's argument as a given. I just don't think his concerns matter that much. The big question as to AI spending is what kind of returns and cost savings these massive investments will or won't bring. That is the key question. And we won't know the answer for a while. And the answer will not be determined either way by a change in depreciation schedules. Burry says he will be coming with more stuff on November 25th. So stay tuned. Finally, I just want to flag a continuing trend that was discussed in my recent interview with Glenn Shore, the financials analyst at Evercore. The trend of this year of big banks like Goldman and Morgan Stanley outperforming private equity firms continued this week, with both Goldman and Morgan Stanley reaching new all-time highs midweek. So for the year, Goldman is up around 47% and Morgan Stanley is up around 35%. But Blackstone is down 16% this year and Apollo is down around 20%. At least this year, investors want to play strong M&A and a good IPO calendar by buying Goldman and Morgan Stanley, and they continue to express their worry and fears about the growth in private credit by avoiding the flagship private equity firms. Now back to earnings. First up, CoreWeave. This is a new AI-related company. It went public only this year. It is an AI data center builder and manager. Monday night, it posted solid Q3 results with revenue and operating income both beating and with revenue backlog up an impressive 85-ish%. So nothing wrong here. But because one data center project is behind schedule, it reduced guidance for the December quarter, and that's why the stock was down 16% on Tuesday. Let me just add that there was also confusion on the conference call. At one point, management said the problem was one data center, but later said a data center provider, which some interpreted as Core Scientific, the company CoreWeave tried to buy unsuccessfully. So CoreWeave management did itself no favors on its call. But just a reminder, the consensus is that CoreWeave will only turn profitable in 2027, and the 2027 PE was around 47 times before the stock went down after earnings. At those kinds of multiples, a company cannot disappoint in any way. But just to give you a quick idea of how rapidly this company is growing, Q3 revenue of $1.4 billion was up 134%. That's revenue versus last year. The one caveat I have with this company is that although demand is very strong, so is competition. GPU cloud providers, of which CoreWeave is one, are fighting to win contracts, and many of these competitors are private and backed by big financial backers. So for example, this week, Anthropic announced that it is developing AI data centers in the US, but with FluidStack, a UK-based company. Right now, there is enough demand for everyone, but should demand ever slow, we could see a market share food fight. Next up, Cisco. This is also an AI-related play. The company sells a bunch of different kinds of routers that connect varied kinds of technologies together. Arista, which we spoke about last week, is its chief competitor. Cisco has a weird fiscal year that ends in July. It reported 1Q06 Wednesday night. Numbers were good, but Cisco has many traditional enterprise businesses that currently weigh on its growth. So the company reported earnings per share of $1 versus 91 cents last year, 10% growth, and versus a consensus of 98 cents, so a slight beat. Revenue rose 8% and beat the consensus. And the company raised both revenue and EPS guidance for both the next quarter and for the fiscal year. It raised guidance because of the strength in demand, of course, for AI-related products. But even at the new EPS guidance for the fiscal year of $4.12, earnings per share growth is still only 9%. So yes, Cisco is benefiting from AI-related demand, but its legacy businesses are still keeping growth slow relative to its competitor, Arista, which should see 2026 EPS growth of around 20%. But there is no question that AI is helping Cisco. These growth results are still better than what the company has achieved in some time. As a result, the stock was up nicely on this earnings report. Paramount reported Monday night. This is the first quarter of the combined Paramount-Skydance combination. Just to give you an idea of how much has changed in this industry, Paramount's market cap is, get this, $17 billion. And Netflix's market cap is, get this, $475 billion. Who was David and who was Goliath has completely flipped. Anyway, Paramount reported it posted revenue of $6.7 billion, which was flat versus last year. But the company outlined an additional $1.5 billion in savings post-merger. And all of this really doesn't matter that much. The big question is whether Paramount will be able to buy Warner Brothers, and the dance between those two companies continues. Disney. While Paramount is tiny compared to Netflix, Disney does have size and a market cap of over $200 billion. So in the current land grab for entertainment, Disney is second to Netflix. Now, Disney reported Thursday morning with mixed results that show some strength in its streaming business, but continued weakness in its legacy media businesses. Disney's earnings were $1.11, which is down 3% versus last year, but beat analysts' expectations of $1.05. Revenue was $22.5 billion, slightly down versus last year, and also slightly less than expected. No matter how you look at these numbers, they are just not great. There's no total growth here, at least not yet. Now, on the positive side, streaming operating income rose 39% to $352 million, but linear networks, one of the company's legacy businesses, dropped 21% to $352 million. This is the yin and yang of Disney. New streaming businesses are good, but not great relative to Netflix. Legacy is bad. And that's why investors who specialize in entertainment stocks are willing to pay a big premium of over 40 times earnings for Netflix. It's just a simpler, cleaner story. Moving on, Circle. This is the stablecoin company that went public in early June of this year at $31. And I've spoken about this company at length before. The stock got as high as $299 in late June, but has corrected considerably since then. Quite a ride. The company's third quarter results were quite good. This is a new company and unusual. For a new fintech company, it reported positive earnings of 64 cents versus only 20 cents expected. Revenue totaled $740 million, up an impressive 66% versus last year. Circle's stablecoin, called USDC, reached $74 billion in circulation, which is more than double a year ago. However, Circle increased its expense forecast, and I think that's partially why, despite these impressive results, the stock was down 12% on Wednesday, the day it reported. The other reason why the stock was down is this Thursday, 200 million shares held by insiders are unlocking post-IPO and can theoretically be sold. Let me also point out that the current consensus for 2026 is only $1.34, which creates a 2026 PE of around 70 times. But given the 64 cents this quarter, I'm sure the estimates are going quite a bit higher. But even so, the 2026 revised PE will still be very high. And one thing we've learned this quarter about high flyers is that they can't disappoint on any metric, actual or perceived. It's just one of those times. The stablecoin space is very interesting and hot within the payment space right now. The key is who is going to establish the dominant market share. We will be talking about this, I'm sure, for a long time. And now for the mailbag. Just one question this week, and it's from Andre, who points out that I have said many times that we are in an M&A advisory boom. He asks, I would really appreciate understanding the key data points or indicators you are observing that support this view. Now, here is an example of where institutional investors have access to information that retail investors generally do not. There are many databases out there that provide important information, and those databases span the gamut of industries. Here, I'm focusing on data from Deal Logic. I'm putting on the screen two charts that show M&A close volume and announced volume. The key is to look at the announced volume, which is moving upwards rapidly. And for those of you who want to look at these charts more carefully, go to my website, realeismanplaybook.com. In the blog section will be a summary of today's wrap with this chart in the notes. And that's the wrap. One of the many themes we have explored over multiple interviews is how varied industries have changed from the impact of technology and social media and AI. We are continuing that exploration this coming Monday, when we will post an interview about the book industry. I interviewed 2 literary agents and a book publisher. We explored how much the book industry has changed because of Amazon and social media, and how much it is already changing from the impact of AI. Hope you will tune in. This last Monday, I posted an interview with Glenn Shore, the financial services analyst at Evercore. Glenn covers alternative asset managers, traditional asset managers, and big traditional financial institutions like Goldman Sachs, Morgan Stanley, and Bank of America. We had a very wide-ranging conversation with particular focus on growth in private lending and any potential lurking problems, which is a really hot topic these days. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcasts and the financial literacy masterclasses. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes, as well as the financial literacy masterclasses and some other goodies as well. Check it out, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.